At 6:12 on a Thursday morning, in a quiet neighborhood outside of Columbus, Ohio, Gerald sat at his kitchen counter with the blue glow of a laptop screen reflecting off his reading glasses. The house was still, the coffee maker dripping in a slow rhythm behind him, and a printed brokerage statement lay flat beside the keyboard with a circled number near the bottom showing $738,400. He had been staring at that figure for almost 20 minutes, his index finger tracing the line between his traditional IRA balance and the monthly withdrawal amount his advisor had suggested. Gerald had retired 11 weeks ago, and for the first time in 41 years of working, nobody was going to hand him a paycheck on Friday. The spreadsheet he had built the night before was supposed to make him feel in control, but the columns of numbers only deepened the knot sitting just below his ribs. His hand hovered over the mouse, cursor blinking on the confirm withdrawal button of his brokerage portal. He leaned back in the chair and exhaled slowly, the kind of breath you take when you realize the decision in front of you has weight you didn't fully anticipate. The question was not whether he had enough money, because the balances across his accounts told him he did. The question was which account to pull from first, and whether the order of that single choice could quietly reshape every tax return he would file for the next 2 decades. Gerald's situation is far more common than most people think. Every year, a significant number of new retirees face this exact moment, choosing which account to tap without understanding the tax consequences that cascade from that decision. There is a name for getting this wrong, and financial planners call it withdrawal sequencing risk, a term most people never hear until the damage has already started. This is where retirement gets expensive in ways that don't show up on any statement. The cost is invisible, buried inside tax returns and Medicare premium notices that arrive years later. And that is exactly what this video is going to walk through, piece by piece, so you can see the full picture before you make your next move. You'll understand exactly why the order you pull money from your accounts matters more than the total amount you've saved. You'll see how one withdrawal decision can push you into a higher tax bracket and trigger surcharges most retirees don't learn about until the bill arrives. You'll learn the specific window of time between retirement and age 73 that gives you a rare chance to restructure your tax future. And you'll leave with a clear sequence of steps you can apply to your own accounts before December 31st of this year. You don't need a finance degree to follow what comes next. You just need 15 minutes and a willingness to look at your own numbers honestly. Retirement is not simply the continuation of your working life minus the commute. During your working years, you had one main source of income and one set of rules for how it got taxed. But once you retire, your income can come from 3, 4, or even 5 different sources, each with its own tax treatment. Think of your retirement accounts like ingredients in a recipe, because the order you combine them and the quantity of each one you use will determine whether the final result nourishes you or leaves a bitter taste on every April 15th for the rest of your life. If you've just stopped working, or you're within a few years of doing so, this applies directly to your own kitchen counter and your own set of balances. The recipe analogy is not decorative here, because just as a chef controls flavor by adjusting when each ingredient enters the pan, you control your tax bill by adjusting when each dollar enters your taxable income. The recipe your retirement income follows has 3 primary ingredients, and the sequence in which you add them changes everything. Imagine you're building a dish where adding too much of one ingredient too early overwhelms the others and ruins the balance for the entire meal. Your retirement accounts work the same way, and the flavor you're trying to control is the amount of income the IRS sees in any given year. Getting the proportions wrong doesn't just affect one year, it compounds across every year of retirement. The first ingredient is your traditional IRA or traditional 401k. These accounts were funded with pre-tax dollars, meaning you got a tax deduction when you put money in during your working years. Every single dollar you withdraw is treated as ordinary income by the IRS, taxed at your current federal income tax rate, as though you earned it from a job. If you pull $60,000 from your traditional IRA in a given year, the IRS sees $60,000 of taxable income, and it stacks on top of any other income you already have. This is where most retirees keep the bulk of their savings, and it's the ingredient that can overwhelm the recipe fastest. The second ingredient is your Roth IRA or Roth 401k. You funded these accounts with after-tax dollars, which means you already paid income tax on that money before it ever went in. Withdrawals from Roth accounts in retirement are completely tax-free, as long as you're over 59 and a half and the account has been open for at least 5 years. This makes the Roth the most flexible and valuable ingredient in your retirement recipe, because you can take any amount from it without adding a single dollar to your taxable income. The contrast with the traditional account is dramatic, and understanding this difference is the foundation of everything that follows. The third ingredient is your taxable brokerage account, the one that's not inside any retirement wrapper at all. Gains in this account are taxed as capital gains, which for most retirees fall into the 0% or 15% long-term capital gains rate, depending on total income. Dividends from this account also show up on your tax return, and the cost basis of each position matters when you sell. Now that you can see all three ingredients sitting on the counter, the real question becomes how to measure them out across each year of retirement so your overall tax bill stays as low as possible. Most retirees follow a simple intuition that sounds perfectly logical on the surface. They think they should spend down their taxable brokerage first, then move to their traditional IRA, and save the Roth for last. The reasoning feels clean, because you'd be preserving the tax-advantaged accounts for as long as possible. And honestly, 20 years ago, this sequence was standard advice from most financial planners. Here's the thing. If you follow that intuition and leave your traditional IRA untouched for years, that balance keeps growing tax-deferred, getting larger every single year. Then, when you reach age 73, the IRS forces you to start taking required minimum distributions. And by that point, the balance may have grown so large that your RMDs push you from the 12% tax bracket straight into the 22% bracket, or even the 24% bracket. What felt like a smart preservation strategy quietly built a tax bomb that detonates right when you have the least flexibility to do anything about it. The jump from 12 to 22% on $100,000 of forced withdrawals means an extra $10,000 in federal tax that year alone. That is money you could have kept by simply adjusting the recipe earlier. The second consequence is one that catches retirees completely off guard, and it's called IRMAA, which stands for Income-Related Monthly Adjustment Amount. Medicare uses your tax return from 2 years prior to determine whether you owe a surcharge on your Part B and Part D premiums. If your modified adjusted gross income crosses certain thresholds, your monthly Medicare premium jumps from the standard $174.70 to well over $400 per month. For a married couple, that surcharge can add more than $5,000 a year in Medicare costs alone. The connection between your withdrawal order and your Medicare premiums is the invisible thread that most retirees never see until the letter arrives. The third consequence hits your Social Security check directly. If your combined income, which includes half of your Social Security benefit plus all other taxable income, exceeds $44,000 for a married couple filing jointly, up to 85% of your Social Security benefit becomes taxable. That means a withdrawal from your traditional IRA doesn't just create its own tax, it also drags a portion of your Social Security into the taxable column. Run your own numbers from last year's return, and you may find this has already started happening to your own Social Security benefit. The cascade works like too much salt poured into the recipe at once, overwhelming every other flavor in the dish. Most retirees discover this connection 2 or 3 years into retirement, after the pattern has already cost them thousands. Gerald, back at his kitchen counter in Columbus, was staring at exactly this cascade without knowing it. His plan to withdraw $72,000 from his traditional IRA would push his combined income past the threshold, making 85% of his Social Security taxable and triggering a Medicare IRMAA surcharge that wouldn't show up until 2 years later. The spreadsheet he had built didn't have a column for either of those costs. The dominoes keep falling, and by the time you notice, 3 or 4 years of unnecessary tax has already left your accounts. The real cost of getting the withdrawal order wrong is not just 1 year's tax return, but the cumulative damage across 15 or 20 years of retirement. Consider a retiree who overpays by just $6,000 per year in combined federal tax, Medicare surcharges, and Social Security taxation. Over 20 years, that is $120,000 that could have remained invested and compounding in their accounts. The math here is not abstract. It is the difference between running out of money at 87 and having a cushion that lasts until 93. Now think about this. Between the year you retire and the year you turn 73, when required minimum distributions begin, there is a golden window that most retirees accidentally waste. During this window, your taxable income is often lower than at any other point in your adult life, especially if you've stopped working but haven't yet started collecting Social Security. These low-income years are the cheapest years to recognize taxable income because your tax bracket is at its lowest point. The majority of retirees sit in this window doing nothing, leaving the lower tax brackets completely empty. They treat this period as a time to coast, when in reality it is the most strategically valuable period of their entire financial life. The counterintuitive move is to deliberately pull money from your traditional IRA during these low-income years, even if you don't need it to cover your expenses, and convert it into a Roth IRA. This is called a Roth conversion, and it means you pay tax on the converted amount at your current low rate, instead of letting it grow and be taxed later at a higher rate. If you're in the 12% bracket today and your RMDs would push you into the 22 or 24% bracket later, every dollar you convert now saves you 10 to 12 cents on the dollar in future tax. The math on Roth conversions during the golden window is some of the most favorable arithmetic in all of retirement planning. This is the ingredient you add to the recipe in a controlled, measured way while the heat is still low. Each dollar you convert from a traditional IRA to a Roth moves permanently from the taxable column to the tax-free column. Once it's in the Roth, it grows without ever being taxed again, and it's never subject to required minimum distributions. You're essentially prepaying a small tax bill now to eliminate a much larger one later. The key is calibrating how much to convert each year so you fill the lower brackets without spilling into the next one. This is the quiet truth of retirement income planning. The person who pays a little tax on purpose in the right years keeps far more money than the person who avoids all tax as long as possible. Ask yourself right now which tax bracket you're actually sitting in this year and whether you've been letting the cheap space in that bracket go completely to waste. Paying tax voluntarily feels wrong, but the recipe works only when you add each ingredient at the right temperature, in the right amount, at the right time. Eleanor is 64 years old, living outside of Portland, Oregon, where she spent 28 years as a school district administrator. She retired last spring with $482,000 in her traditional 401k, $61,800 in a Roth IRA, and $93,400 in a taxable brokerage account. Her Social Security, which she began collecting at 62, pays her $2,140 per month, or $25,680 annually. Her annual living expenses, including property tax and health insurance through the marketplace before Medicare, run about $54,000 per year. Eleanor does what feels natural. She takes the difference between her Social Security and her expenses, roughly $28,300, entirely from her traditional 401k. That withdrawal, stacked on top of her Social Security, pushes her adjusted gross income to nearly $54,000, which means about 62% of her Social Security becomes taxable, and she lands in the 22% federal bracket on the top portion of her income. Her total federal tax bill for the year comes to approximately $4,900. Plus, she has set herself up for a Medicare IRMAA surcharge in 2 years. If your own approach looks similar to Eleanor's, you're not alone, but now you can see exactly what it's costing you year after year. Now consider Daniel. He's 64, living outside of Richmond, Virginia, retired after 30 years in logistics management. His traditional IRA holds $395,000. His Roth IRA has $118,000, and his taxable brokerage account sits at $127,600. His Social Security is $2,210 per month, or $26,520 per year. His annual expenses are about $53,000. Daniel approaches the recipe differently, measuring each ingredient with care. He takes $12,000 from his taxable brokerage account first, most of which is taxed at 0% long-term capital gains due to his low income. He then pulls $14,480 from his Roth IRA, completely tax-free, bringing his total to $26,480, which nearly covers the gap between Social Security and expenses. He withdraws just $4,000 from his traditional IRA, keeping his total taxable income low enough that his Social Security remains almost entirely untaxed. His federal tax bill for the year comes to approximately $860, compared to Eleanor's $4,900. The difference in one single year is over $4,000, and Daniel's combined income stays below every Medicare IRMAA threshold. Now Daniel adds the Roth conversion layer. Because his taxable income is so low, he has room in the 12% bracket to convert an additional $31,000 from his traditional IRA to his Roth. He pays roughly $3,720 in tax on that conversion, but every one of those $31,000 now sits in a Roth where it will never be taxed again and will never trigger an RMD at 73. The math on this single move saves him over $6,800 in future tax compared to waiting and withdrawing that same amount later at the 22% rate. If your income is unusually low this year because you recently stopped working, you may have this same window open right now, and it will not stay open once your Social Security or RMDs push your income higher. Over 15 years of retirement, the difference between Eleanor's approach and Daniel's adds up to more than $68,000 in total tax and Medicare premium savings. That is not a hypothetical number. It is the cumulative result of measuring the ingredients differently each year. The recipe is the same 3 accounts, the same Social Security, nearly the same expenses, but the order and proportion change everything. The first thing to do is pull your most recent tax return and look at your adjusted gross income line, because that single number determines which tax bracket you're in and whether any of the surcharges or thresholds discussed here apply to you. If you filed jointly, find line 11 on your 1040 from last year. Compare that number against the current federal bracket boundaries and the Medicare IRMAA thresholds, both of which are publicly available on the IRS and Medicare websites. The second step is to map out every source of income you'll have this year, including Social Security, pension, any part-time work, rental income, and required distributions. Add them up and compare the total to your annual expenses. The gap between your guaranteed income and what you actually need to spend is the amount you'll pull from your accounts this year, and the order you pull it determines your tax outcome. If your guaranteed income already covers most of your expenses, you may have very little you need to withdraw, which means most of your bracket space is open for Roth conversions. If there's a large gap, focus first on which account fills it in the most tax-efficient way. The third step is to fill the gap strategically using the recipe approach. Take from your taxable brokerage first, especially any positions with minimal gains or losses you can harvest. Then use your Roth to cover whatever remains, keeping your taxable income as low as possible. Once your expenses are covered, look at how much room is left in the 12% bracket, or whatever bracket you're targeting, and consider converting traditional IRA dollars into your Roth up to that ceiling. This is the step where the long-term compounding benefit is largest, and it is the one that most retirees skip entirely. The fourth step is to run this entire calculation again in October or November, before the tax year closes, to make sure your estimates still hold. Income can shift throughout the year from unexpected capital gains distributions, required minimum distributions you forgot to account for, or changes in Social Security. Before this year ends, you owe it to yourself to sit down with a CPA or a fee-only financial planner who can pressure test your numbers and make sure you haven't left money on the table. This is not a conversation you want to have in April when it is already too late to change anything. Back at that kitchen counter in Columbus, Gerald eventually closed the laptop and picked up the phone. He didn't make the withdrawal that morning. Instead, he called a fee-only planner his neighbor had recommended, and the first question the planner asked was not how much he wanted to withdraw, but which bracket he was currently sitting in. That single question changed the entire direction of the conversation, because Gerald had been ready to pour $72,000 of traditional IRA income into a year where a more measured approach could have saved him over $5,300 in tax and avoided the Medicare surcharge entirely. The recipe for retirement income is not about which account has the most money or which one feels safest to touch. It is about proportion, timing, and temperature, adjusting each ingredient to the conditions of that particular year so the final result comes out clean and efficient. You have spent decades earning and saving, and the way you draw that money down deserves the same care and attention you gave to putting it in. The lesson is simple, even though the execution takes thought. The order matters more than the total. If you're sitting with your own set of account balances right now, write down in the comments which step felt most relevant to your situation, because the conversation in the comments often helps other people in the same position find the detail they were missing. If this changed the way you're thinking about your own withdrawal order, a like helps more people in the same situation find this before tax season.